it's getting hammered. The reaction by doing it the other way, dumping it, the reaction that it has, it's, oh my gosh. At the same time, you have one of the largest short positions ever on SLV. Over 80 million shares are naked short to affect this. There's a battle going on right now where this could end up being one of the biggest delivery months, one of the top 3 biggest delivery months ever. And at the same time, it's getting hammered. So the shares are being driven down, which affects the price. But yet we're seeing, as they drive the paper price down, massive deliveries in both gold and silver this month.
Gold prices slipped below the $4,000 mark on Monday as investors shifted away from safe haven assets amid renewed optimism over a potentially China trade deal. Spot gold dropped to around $3,980 per troy ounce, while December futures declined more than 3%, briefly falling under the $4,000 level. This pullback followed encouraging signals from both Washington and Beijing, hinting at a possible breakthrough in trade talks ahead of the meeting between President Trump and Chinese leader Xi Jinping. Even after this correction, gold futures have been holding above $4,000 following the biggest one-day drop in over a decade the previous week. That decline halted what had been the strongest year-to-date rally in more than 40 years, ending a 9-week winning streak. According to Bespoke Investment Group, while such reversals have sometimes marked short or long-term peaks, many also occurred within long-term uptrends, suggesting gold's recent weakness could be temporary. The metal may have lost some of its shine, but it might just need a little polish. As we said before, taking some profits after a major rally and buying back at lower levels seems to have been a smart move, and that advice has aged well. Backhand index pointing right. If you enjoy these insights, make sure to smash the subscribe button, like the video, and stay tuned for more updates on gold and silver markets.
China building its own financial plumbing to get around the U.S. dollar system because it's no longer trusted. And, we focused a lot on Enbridge, but the CIPS system, the cross-border interbank payment system, which is China's version of SWIFT, is, in my opinion, the rails to what the Enbridge system will be. It's over 185 countries already are using CIPS to settle, including the Asian countries, which we've talked about before, which are 35% of global GDP right now, and China's biggest trading partner, twice the population of the United States. But the kicker is that once countries accept payment in yuan, like Russia sells oil or Brazil sells soybeans, they don't have to just sit on stacks of Chinese yuan. Through the Shanghai Gold Exchange, those yuan balances are actually convertible into gold. And this means that exporters who don't want to hold yuan can take that money and they've earned and go right to the Shanghai Exchange and convert it into gold bars. It's effectively a yuan to gold backdoor. And the next vault, as we talked about, is being built in Saudi Arabia. And this is why you'll hear analysts talk about this petro-yuan to gold trade. Instead of taking dollars for any commodity, the yuan is now convertible into gold. It's not backed by gold, but it is immediately convertible into gold. In essence, the system is finding an alternative to the dollar-based system, which since 1971 has only been backed by trust and confidence. And you can see that that's slipping on many levels. And so I do think that this is the underlying reality that isn't getting better, nor is our fiscal responsibility. We are at 123% debt to GDP. Most of my career, any country at 100% would be considered a banana republic. And in just 71 days, we at $100 billion a week. How long can that go on? I think, people need to think about this. And maybe this is why you're seeing big money start to move into gold. The central banks have been front running it. And now you see Bank of America, Jefferies, Morgan Stanley, JP Morgan. They're all saying they're reassessing their outlook on gold all the way up to 25%. And when you see Michael or the big bond trader, the bond king for BlackRock, it's an emotional thing to see price fall the way that it did, but it is really done in a very irrational way that isn't being reported. And they're dumping it in a matter specifically to affect that type of sentiment and that type of aggravation.
In today's news recap, silver price slips below $47 due to optimism over U.S.-China trade deal. Silver price remains subdued for the third successive session, trading around $46.80 per troy ounce during the Asian hours on Tuesday. The price of the safe haven silver declined 3.78% in the previous session amid risk on sentiment driven by the optimism over the U.S.-China trade negotiations. Senior officials from the U.S. and China announced over the weekend in Malaysia that they had reached a framework agreement on tariffs and other major issues, setting the stage for Presidents Trump and Xi to finalize the deal during their meeting later this weekend. South Korea. U.S. Treasury Secretary Scott Bessent said that President Trump's threat to impose 100% tariffs on Chinese goods is effectively off the table. Bessent added that China has agreed to make substantial soybean purchases and to postpone its rare earth export controls for a year while they re-examine it. However, the downside of the gray metal could be limited due to the increased likelihood of a rate cut by the U.S. Federal Reserve Fed on Wednesday. The Fed is widely expected to lower interest rates by another 25 basis points, bringing the benchmark rate to 3.75 to 4% at its October meeting. The CME Fed Watch tool indicates that markets are now pricing in nearly a 97% chance of a Fed rate cut in October and a 95% possibility of another reduction in December. Moreover, market sentiment may turn cautious as the U.S. government shutdown has ignited debate among Federal Reserve officials as policymakers weigh whether to cut rates soon to support a weakening labor market or maintain current levels amid inflation. That remains persistently above the Fed's 2% target. Now smash the subscribe button and turn on notifications.
Well, you can see the reaction by doing it the other way, dumping it, the reaction that it has. It's, oh my gosh. And to your point of fiscal irresponsibility, the U.S. government added $1 trillion to the debt in 71 days last month. 71 days from 37 to 38 trillion just recently. And the interest cost on the debt is mounting at a level where, it's now the largest budget item. And none of this includes the unfunded future liabilities, which are so large and disgusting that I don't know how you pay them off without devaluing the currency. Ultimately, that is how it has to be done, as far as I am concerned. But yeah, this is a deal where the shipments out of both the COMEX in New York, or the shipments into COMEX in New York or out of, some of it stayed in there, will be roughly 38 million ounces this month of silver, and that will put it on pace to be one of the biggest delivery months ever. This is a deal where at the same time you have one of the largest short positions ever on SLV. Over 80 million shares are naked short to affect this. There's a battle going on right now where this could end up being one of the biggest delivery months, one of the top 3 biggest delivery months ever. And at the same time, it's getting hammered. And SLV has an 84 million ounce short position or share, 84 million shares. I guess I don't know if that's ounces or shares. For the last, it's 83.86 million, represents 15% of all outstanding shares. So I guess it's shares. So the shares are being driven down, which affects the price. But yet we're seeing, as they drive the paper price down, massive deliveries in both gold and silver this month. It's a very interesting, hard to decipher market. But when you see these kinds of movements where the paper price gets driven down and there's tremendous physical buying, it should be eye-opening. And at the same time, when you look at, them shorting SLV, it's much more difficult to point fingers at who's doing it when it's not done directly through the COMEX. And you should never be able to grotesquely short, as Ed Steer says, a proxy like SLV, but it certainly has its impact on the price. And again, Think about this. We added $1 trillion in 71 days. That's just unheard of, and it's unsustainable. And our debt is rapidly approaching 130% debt to GDP, where other than Japan, no one's ever come back from that. And, the difference with Japan is that, they're not the world reserve currency. They have a budget surplus, and their debt not only is contained with yield curve control, it's mostly owned by the hedge funds, the government, and the people. And so they can get away with it. We can't. And if you're holding treasuries and you see the fiscal irresponsibility mounting, at some point, this debt does become a problem. And the people who point to it not being
I think are missing the what do you think of Andy take? Do you agree that a massive gold and silver squeeze could happen in December? Will gold and silver top very soon? Post in the comments section down below your honest opinion.